Good morning, this is Kim, and I want to speak with you a little bit about Chapter 4. I really think Chapter 4 is an important chapter because we're looking at return and risk, and we need to really understand these concepts so we can move forward in evaluating specific types of investments. So I've started on this page the concept of return just to make sure that you understand what this means. Return or percent return would be how much money we're going to earn on our investments. So, for example, if we owned an individual stock over a year and that stock paid dividends, then that would be part of our return. Also, we're going to look at how that stock price has changed over that year. If it's gone up, then we have capital gain or price appreciation, another component of return. And this is significant to us because we want to buy investments where the return is something that we've accepted or something that we want. So we need to review it, we need to look at it, and maybe not calculate it because there's a lot of secondary resources out there that help us calculate returns on investments. So let's start with that. This is ExxonMobil, and what they've done here is they've looked at the dividend income on this investment over a period of time, 10 years. And they've also looked at the price at the beginning of the year and the end of the year. And subtracting those gives us the capital gain. Again, that price appreciation is called capital gain. Dividend income is a different type of income. It would be a cash income component. Anyway, the book did this for this 10-year period of time and then just calculated simple averages. So we can see that the average dividend over this 10-year period was $1.79. That was the average. Average annual per year. Capital gains was $4.12. That means the total gain, the sum of these two, was $5.91, or a percentage equivalent of 9.6%. So the average annual return on ExxonMobil for the year 2005 to 2014 was 9.6%. And you would say to yourself, hey, that equals my expected return or what I wanted to receive on this particular stock investment, so I'm happy with this return. However, it does not give us any indication as to what will happen with ExxonMobil in the future. And this is something we need to think about. We have a lot of historical information that we can go back to and reflect on and calculate. But again, that doesn't necessarily predict what's going to happen in the next 10 years. So there's this gray area. Can we assume that Exxon, since it's been very well managed over the last 10 years, that it's going to continue in the future? Maybe. But again, we should be looking at information, secondary, of course, or even primary. You could even look at information on your own and make some conclusions. For us, we're going to rely on some experts who actually evaluate stocks, and we're going to get to this soon. We're going to go to some detailed Morningstar performance reports and projection reports that are done by individuals who just focus on Exxon. And they're not just looking at historical information. They're going to look at their management. They're going to look at the market for what Exxon produces. They're going to look at their competitors. They're going to put the whole picture together and give us more information so we can make good projections about how not only Exxon but other investments are going to do in the future. So, concepts of return. Again, internal characteristics of a company. What are they doing? I just spoke about this with regards to Exxon. That would be the quality of the firm's management. And there's this whole qualitative component that we want to review if we're going to buy individual stocks in particular. Again, looking at their industry, their competitors, their management, etc., their growth plan would be another thing that we'd want to evaluate. That's a qualitative component or the internal characteristics of a company. Now, in addition to that, we have all these external forces. And that's what I had you look up last week. How will Trump's policies potentially affect our markets? Those would be the political environment. Does it really have a play in here for Exxon? Are they going to make regulation decisions and new negotiations that are going to benefit Exxon? These are the questions that we need to ask. The economic environment, what's just happening in our economy overall? Are we headed for another recession? Where are we in the economic cycle? Those types of external forces that affect our investments. And then lastly, we have inflation. So you know that inflation is really just the general increase in stuff we buy, increase in price. Stuff prices go up over time. And if prices are going to increase, well, then our investment returns will probably increase because we want to make enough money to cover inflation and then make more to grow our wealth. So let's move on. Historical returns, I'm going to skip this because we've already talked about it. I find this chart to be very informative. What it does is it takes all many countries and it evaluates their stock performance over time and their government bond performance, which we're going to be studying next week, both long term and short term. Long term would be bonds that have a maturity date that's 10 years out. The bonds aren't going to mature for 10 years. And if that doesn't make sense right now, it will later. Short-term government bonds are those with a maturity date that's less than 10 years. And then over here we have the inflation rate. If we go down to the United States, we can see that for this very long period of time, stocks have returned an annual average return of 9.6%. Whereas bonds, on the other hand, are about half of the amount of stocks. Well, why is that? And the real answer is it has a lot to do with risk. There's a lot more risk in stocks, but also the potential for a lot more gain. So if you're willing to take on the amount of risk, then some of your portfolio should be invested in stocks. On the other hand, if you're not happy with taking on a lot of risk, then this might be the area for you because they're not as risky, but their return is going to be half as much. So we'll learn how to dig deep and really understand how much risk you as an individual are willing to take on to grow your wealth. And then lastly here, our average inflation rate is 2.9%. So prices increase on average 2.9% each year. So if we're only making 5% in long-term government bonds, but prices are going up 3%, what are we really making? The differential is 2%. That's what we're making on our investments. Now we are beating inflation and we are making money, but it's not as significant as the difference between investments in stocks and the inflation rate. Again, what I want you to take from this is that inflation matters. It does. We need to understand what it is. We need to factor it into our investment decisions and how we pick different asset classes. I'm going to skip time value of money for now. I'm going to get to that in a later section. But what you should know is that, think about it this way. If someone says, hey, do you want $100 today? Or would you like $100 6 months from now? And to me, it's not a difficult concept. If you received the $100 today, you could effectively invest that money and you could earn a rate of return. If you don't take it for 6 months, then you've lost that return that you could have earned in that 6-month period. That's what time value of money is all about. I like to tell my students, when should we start investing for retirement? Should we wait until we're in our 40s until retirement starts to matter? I hope you say the answer is no. We need to think about investing now, sooner, because the sooner we get started, the more time we have to make money. And time and compounding returns are significant. They are significant. So the time to start investing is just as soon as you can. All right, let's move on. There are several different types of returns that your book talks about. Again, I'm not going to go into the math calculations as I mentioned in the homework. Instead, I really just want you to understand that there are different types of methods for measuring return, and you should be aware of what they are. Don't need to calculate them. We're going to rely on a lot of already published information. We've already researched a lot of different sources, and we can use that information instead of calculating everything ourselves. Okay, so again, real risk-free rate and required returns. So your real return, again, I've already mentioned this, is the return you receive on the investment minus the inflation rate. Because again, you paid more for things that you use, gas, food, clothing, etc. So we have to take that into account. So we may have earned 10% on our portfolio on everything we own in investments. But if the inflation rate was 3%, then our real return was 7%. We could get into all these detailed equations, but I don't think it's necessary. Again, what I want you to understand is that inflation matters, and then our own internal, how much risk we're willing to take and how much we want to receive on our investments will factor into the decisions that we make. Okay, so I'm going to skip through this and I'm going to go to this type of return that's talked about in the book. And this is a return I use all the time for my clients. I use a holding period return. So in a holding period return, I look at the amount of the investment at the beginning of the year and the amount of all their investments at the end of the year, and I take the difference between the two, divide it by the beginning of the year amount, and I can calculate a return. What it was the percent return that we received on our investments over the last year. And my clients like to see that. Again, they want to see returns every year on their investments. So this is the measure that I find most useful for them. And maybe you will find most useful for you. But you do understand that we have to look at the bigger picture because we don't just hold investments for 1 year, at least not all of our investments. Some we do. I'm going to go to this slide over here and I want to look at holding period return for a savings account, a common stock account, bond account, and real estate. So we look at all the cash we received from each of the different accounts. This would be dividends, this would be interest payments, and then we didn't receive any on real estate here. We look at the beginning of the year value, the end of the year value, and we can calculate the holding period return. So you can see in this particular example, the savings account earned 6%, common stock earned 12%, bonds 11%, and real estate 10%. This is just an example because of course in the last year our savings account are not going to earn us anywhere near 6%. But just an example of how it all works. And then you can put them all together and said overall, how much did your portfolio earn? So I like this. I think it's very important information. Okay, I'm going to tap through here really quickly and just see if there's anything else. Okay, no, I'm going to stop here because this is where we're going to move into risk. So I want you to listen to this and then I'm going to make another video on risk. Thanks so much. Bye.